Welcome to this webinar. Today, I want to talk about a couple of investment principles and also update you on the most recent performance of the individual investment portfolios of Nfmw. Let's jump right into some of those principles. First thing I want to talk about is risk. How do we define risk? There are various risks for retirement fund members. For example, market risk. This is the risk that the whole market or even a single market instrument moves in an adverse manner and obviously in a downward trend or giving you negative returns. Another type of risk would be inflation risk, and that is the risk that the net return for members does not keep pace with inflation over time. That will result in the reduction of your purchasing power and also not provide you with a sufficient income after retirement to maintain your living standards. In the investment world, we measure risk with standard deviation, volatility, or even value at risk. Volatility speaks to the large deviation in prices that we may find for certain types of investments. For example, equity investments and the prices attached to shares could move in quite a big way on a daily basis, whereas the value of cash investments are fairly stable over time. The one principle that we need to just remember is that risk is directly related to your reward or your return. The higher the risk in general, the higher the reward. But beware, if you do take on risk, there's also a chance that you can actually lose some of your money. Let's just look at what has happened in March 2020 when the COVID pandemic struck us. You can look at the graph and the red section of that graph. Our all-share market, the South African all-share equity index, lost almost 33% of its value in a very short period of time. Fortunately, it recovered all of those losses within 145 days, a record recovery period. Just to note that this wasn't only the South African market that reacted in such a way, but it was all equity markets across the globe that suffered similar fate. Since August 2020, the market actually recovered and actually gave us another 21% return. That on the back of lockdown restrictions being lifted, good economic growth prospects, and of course the election of Joe Biden as the American president in the place of President Trump. The election of Joe Biden is also perceived to be very good for emerging markets like South Africa. What I just want you to see is the volatility that we can experience on equity prices in very short periods of time. Just want to emphasize as well that no strategic changes were made to the Nfmw investment portfolios during this volatile time. So how do we manage risk, in particular market risk, for example? You've all heard of the saying, do not put all your eggs into one basket. And that's exactly the principle that we also apply to your investments. For example, the aggressive growth portfolio has got quite a significant exposure to South African equities, but not all of the assets are invested into this asset class. Some investments are also made into bonds, property, alternative assets like renewable energy, and quite a significant amount is invested offshore. The principle that applies is that one market event does not necessarily influence all asset classes in a similar way. Therefore, let's, for example, assume that interest rates goes up. This could be bad for bonds but it could be very good for cash. So on a relative basis, in circumstances like that, you would tend to have more exposure to cash than bonds. Or the South African rand could depreciate, which would increase the value of your offshore assets, whilst that could be bad for South African equities, for example. Can you see that the returns that you get by investing or from investing in different asset classes gives you a different return profile on these underlying investments, which just means that overall, a balanced portfolio guard against severe market risk. But what can we expect over the longer term to achieve out of investing in various asset classes? Again, the principle behind it is you have to take on a bit of risk to have sufficient returns or achieve sufficient returns over a very long period to build up a good enough value and fund credit for you to retire one day and get a decent income out of it. It just means that you cannot, for 40 years, invest all your money into a low-risk asset class like cash, which barely will beat inflation over a long period of time. You can see in the table to the left, to the top left of this graph, that equity investments, equities in shares and in companies, on average, given you almost 16% per annum return since 1925, and outperformed cash by quite a margin, and also giving you returns above inflation, which will grow your fund credit in real terms. However, there are periods where equities will underperform cash, especially over shorter periods of time. As I've said before, equity markets are much more volatile than cash investments or even bond investments. And therefore, you do find that sometimes equities underperform against asset classes like cash. How does the fund help its members to mitigate some of these risks and to make sure that its members are invested correctly? The fund offers a default life stages model for those members in particular that's not comfortable or do not want to make an own investment choice by selecting a specific portfolio. It just means that members are de-risked from more aggressive portfolios to lower risk portfolios as they approach retirement or as they near retirement. For example, young members, which have got many years left to retirement, are invested in the aggressive growth portfolio with an exposure to higher risk assets like equities and property, and also quite a lot of international equity. It just means that although that particular portfolio has got high risk investments and can be very volatile in terms of its returns, there's still a long period for members to stay invested into that portfolio to mitigate the loss of sudden market risk, right, where markets have a severe downturn, because markets do recover over a period of time. Once you get closer to retirement or get older, people within the life stages model will be switched automatically from the aggressive growth to the capital growth portfolio at age 55. And again, from the capital growth portfolio into the stable growth portfolio at age 62. The idea here is therefore just to de-risk members as they approach retirement. We do not want to expose members to severe market volatility when they are close to retirement. Just as a change to the fund that we need to relay back to its members is that in March 2020, mind you, in March 2021, the fund changed its way into its approach in terms of portfolio switches, switching members from more aggressive portfolios into lower risk portfolios, in that a phasing in approach is applied. Previously, when members are switched between portfolios, members' full fund credits were switched at the end of the month in which they reached age 55 or 62, for example. The new approach allows a phased-in approach where only a portion of your fund credit is invested when you reach age 55. In this case, 25% of your fund value it will be switched when you turn age 55 from the aggressive growth portfolio to the capital growth portfolio. After a 4-month period, another 25% of your fund credit will then be added to the capital growth portfolio from the aggressive growth portfolio. Also, your future contributions will also follow these proportions. This is then repeated over a period of 12 months until your full fund value is switched or has transitioned from the aggressive growth portfolio into a capital growth portfolio. So it just means that when you turn age 55, your fund value will be transitioned into the capital growth portfolio over a 12-month period. Research has shown that this should provide members with a better outcome over time. Remember, this process is also followed when members are switched at age 62 from the capital growth portfolio to the stable growth portfolio. Of course, members still have the option to choose or select a specific individual investment portfolio at any point in time when they want to do so. Just to give you an idea of the different risk profiles of the portfolio, we give you an idea of the exposure of the portfolios to high-risk asset classes like equity and property. As explained, these assets' prices are fairly volatile and can vary significantly and can have large deviations on a daily basis. But over the long term, taking on a bit of risk is necessary to maintain your purchasing power of your investments. So, for example, the aggressive growth portfolio can be considered to be a moderate to a high-risk portfolio with close to 75% of all the assets in that portfolio invested into a higher risk assets like listed property or equity or even offshore equity. If we just look at the stable growth portfolio, it's considered to be a low or moderate risk portfolio with no exposure, for example, to offshore equity and lower exposure to local equity. That portfolio will also have more exposure to lower risk assets like cash and bonds, suitable for members closer to retirement to mitigate the risk of market volatility and volatile markets close to retirement. It is sometimes difficult to make the right individual choices and to select the right portfolios if members want to do so. It can often be driven by our emotions instead of a long-term investment plan. One must be very sure and follow independent financial advice when one wants to make such choices or switches. We do not want our emotions to get in the way of bad decisions, like fear. If markets go into a sudden downturn, we tend to get scared and want to switch into lower risk portfolios as a result. It may just be the wrong time to do so, as one could easily miss out on any recovery after that. Let's look at a practical example. We've shown this example before, and we just want to again reiterate the effect of making a wrong switch at the wrong time. So we've got two members, member A and member B, both age 30, right? And let's call it a fund credit of 100,000 Rand as at 1 January 2020. They are both invested in the aggressive growth portfolio. Good portfolio to be invested because they still have a very long period to save for retirement and can stomach any market volatility for many years to come. Aggressive growth portfolio is therefore probably the right choice for these members at this point in time. Now we enter into that period in February and March of 2020, when we've had a very severe downturn in the market as a result of the COVID pandemic and the lockdowns, and restrictions, and everything that got imposed at that point in time. Had a severe effect on especially the equity markets and even our bond market. So much so that the aggressive growth portfolio almost lost 25% of its value within a very short period of time. At that point in time, member A decided to do nothing and not to make any change to his portfolio investment and stuck with the aggressive growth portfolio. Member B got scared and decided to switch into a lower risk portfolio and chose the Capital Protector portfolio. As at 31 March 2020, they both had fund values of 85,000 Rand. Remember, they started off with 100,000 Rand at the 1st of January. On 31 March or 1 April, just a day later, the switch came into effect. 13 months later, member B was invested in the Capital Protector portfolio for that period, and member A obviously chose to stick with the aggressive growth portfolio. Member A's fund credit 13 months later grew to 113,000, almost 140,000 Rand, whereas member B's value grew from 85,900 to around 91,800 Rand. There is almost a 22,000 or more than 22,000 Rand difference between member A and member B's fund credits just 13 months after the crisis hit in March 2020. Imagine having had R1 million invested and making that choice to switch to the Capital Protector portfolio. Between the two members, member A would have had 220,000 Rand more than member B, making a choice to move to the Capital Protector portfolio. Remember, member B did not participate in the market recovery because she switched at a point in time where the market was at a very low point. The good news is that all the Nfmw investment portfolios had a significant recovery after the low point in March 2020. Here you can see in the table that 100,000 Rand invested on 18 March 2020 would be worth, if you were invested in the aggressive growth portfolio, almost 150,000 Rand just 13 months later. Stable growth portfolio would have given you a 30,000 Rand return over the 13-month period. All other portfolios also had significant returns after the recovery. The fund remains well balanced and diversified in terms of its investments, and it participated in the recovery after the pandemic losses suffered in that February and March of 2020. It just shows you the value and resilience of a well-defined long-term investment strategy and sticking to that strategy if you do have time on your side. Let's just quickly talk about the prospects of our markets going forward. The recent market turmoil have been quite extreme, and we've experienced a very, very volatile period in terms of returns over the last 18 months from 1 January 2020. The markets recovered quite fast, and on top of that also, added a significant return. The reason for this is basically the economies that opened up again after the lockdown restrictions. Of course, the positiveness of the vaccine rollout globally has a very positive effect. And then also there's accommodative monetary and fiscal policies that's being implemented across the globe by various central banks and reserve banks. It just means that interest rates are very low and it's easy to repay loans. And also fiscal policy creates liquidity in the markets by helping small businesses, building infrastructure, and even getting cash into people's pockets, which lost their jobs as a result of the pandemic. All of these factors resulted in a very good period on equity markets in terms of returns. However, we know that markets can be volatile, and we know that prices also do not always go up. Prices can also go down. The risk in the market today is basically based on inflationary fears. Why? Because of all the money that's been pumped into the economies to make sure that we survive the pandemic. All the money finds its way into businesses and into the pockets of consumers, which spends this money and results in price increases. If inflation gets out of hand, central banks will have to increase interest rates again to curb and mitigate the risk of high inflation. High interest rates is traditionally not very good for equity investments and also for bond investments. We need to caution members to lower their expectations and not to expect high double-digit returns coming out of these portfolios over the short to medium term. Markets can be very volatile, and one needs to stick to a long-term investment strategy to take advantage of growth over a very long period of time. If you need more information on the various individual choice portfolios, you are most welcome to visit our website and get the latest investment fact sheets of the various portfolios. The website, www.nationalfund.co.za, is easily accessible, and fund fact sheets are available for your perusal. Thank you so much for listening to our webinar today. Of course, you are most welcome to contact us and connect with us in any which way. You can call us, email us, or even interact with us through social media. Thank you very much for listening, and stay safe.